I want to shift gears. I want to move away from the indices. I want to talk energies. We have David Williams joining us this morning. He's an investor. He's a forecaster at Page Trader. David, welcome. We were just talking about how it's been, well, a long time since the market's been so headline-driven, commodities, indices for that matter. I guess the question I have for you as a technician, does it make the technicals more reliable or less reliable when we're seeing this kind of intraday volatility tied to some of the fundamentals and, again, oftentimes just headline news?
Hey, good morning, Ben. Great to be here. You know, volatility is for us what makes the markets better for technical analysis. Markets tend to run to distant targets. The market has the power to get to numbers. It has the power to reverse powerfully. We prefer normal or high volatility to trade in, normal, medium, or high. We don't prefer having lesser volatility, smaller than normal volatility. So it is, I would say that I think many technicians would agree that higher volatility helps. It doesn't hurt. It helps the market to be able to do all the things that the technicals are pointing to.
Yeah, it kind of gets us to the levels that we look for or that we've identified, it seems like at times, those volatile swings or the fundamentals that contribute to. You know, we sold off yesterday on the constructive comments from in terms of relating to or describing some of those talks in Istanbul from Russian negotiators, which seemed to be good. Probably one of the more positive comments we had heard in a while. We did hear the Ukrainians kind of dialing them back, basically saying, look, we're pushing for a 48-hour ceasefire to get some of the people out that want to leave at this point and can't, and we still don't have that. So, again, we were trying to provide both sides in terms of representing the story. But, you know, it really shows to the sell-off that we saw in terms of crude yesterday, the rally back today. I mean, on a bit of a roller coaster, as I mentioned earlier in the show, and again, tied to the news and these headlines.
Yeah, no doubt. A continuing combination, Ben, of COVID-based lockdowns in China, which can
that too,
dramatically slow the consumption of transportation fuels and thereby take some heat off the market, along with the slightly positive, as you just mentioned, Russia-Ukraine negotiations, which maybe today are not so positive, are helping to keep the crude oil at somewhat more reasonable prices and certainly off the recent highs of $130 per barrel. Last time when we were on your program, I forecast that we would not be seeing the $130 crude oil price again anytime soon, and that the crude oil market would tend to trade at around 105 to 103, particularly into the third quarter of this year. And as a matter of fact, we are already seeing crude trade at around the 103 to 105, even in this time frame. And we have early indications, Ben, for the second quarter of this year, crude may need to trade even lower at both $94 and at $89 to $87 before reasserting the longer-term uptrend to again trade at 103 to 105 or higher in the third quarter of 2022. So crude oil is not out of the $100 per barrel crude oil business during 2022. We're going to see plenty of it. The market has to be considered to be very volatile and very high priced for much of the remainder of this year in terms of our forecast.
Okay, sounds like the contribution that crude's had to some of those inflation concerns will remain. Then I guess the next question is, with the ongoing negotiations, we're nowhere near the end of the ride yet in terms of this roller coaster ride, it sounds like, as far as some of that intraday volatility. I mean, we're going to continue to get headline news, comments, positive or negative, as talks continue.
Yeah, and you know, Ben, as you know so well, investors are smart. They have already priced in very, very many of the possible outcomes. People think these things through. A lot of what could happen has been priced in, and I give the fact that when something really becomes a fact, it can make a spike in the market. But a lot of things have been priced into the market. A lot of outcomes have been priced into the market so far. So there really will probably have to be some larger surprise to really get crude oil to be back above the $130 mark. And as I said, even in the second quarter of this year, which just begins in a couple of days now, in the second quarter, we're probably going to see 94 and 87. A quarter is a decent period of time, so it's not necessarily going to be right off the first day. But, you know, we're probably going to see some pullback, but we're going to be in the $100 crude oil business for quite some time, continuing into the third quarter of this year.